Biba, let's talk markets with Lisa Erickson, head of the Public Markets Group at U.S. Bank Wealth Management. Lisa, just sort of trying to put a synopsis on your viewpoint. It takes a while, I think, to turn a big ocean liner around. And we are seeing some signs that maybe disinflation is on the horizon at some point. But it's not clear sailing yet, I think is your view. And a lot of the concerns and worries, high inflation, rising interest rates, corporate earnings being affected, they're all still sort of here for a while longer. So you got to be careful.
You put it together well, Joe. We really are moderately cautious, and it is on the back of the fact that we see economic activity continuing to slow, whether it's on the macro front or in corporate earnings. And we still have some of these headwinds that could further impede their progress. Chief among them, the fact that inflation, while it is starting to come down, is still on a bumpy ride. And if you look at the absolute levels, it's still meaningfully above the Fed's 2% target. And so with that, you've got policy continuing to be on the more restrictive side in terms of the monetary environment. And that just makes it tougher sledding for U.S. stock market.
The other thing I thought was interesting, and Steve Leisman's been pointing this out, but the Fed and the markets have come together more. There's not as big of a divergence anymore. And in your view, that's good. It removes one risk to equity pricing. But then you say it's still, there are headwinds from the absolute level of interest rates and inflation. I didn't think the absolute level of interest rates, do you mean they're still too low? Or if they get up to 5%, that's high all of a sudden? Because on a historical basis, we used to do 5%. The economy was great with 5% interest rates.
Well, that's a good point, Joe, that really in the context of a longer term history, the levels we're at now in terms of rates are not excessive. However, just coming from where we've been in terms of very low interest rates for quite a period of time, and then having those higher levels of 4 to 5% can really make a difference in terms of equity market valuation. So if you look at where multiples tend to ride in different interest rate and inflation environments, there certainly is a step change up when you move to levels of 4 to 5% in rates. And certainly as well as those inflation levels have been higher as well. So again, just where we're at overall in terms of pricing pressure and then the knockoff effect on the Fed needing to be attentive to slowing down that inflation provides some risk to the economy.
So if for your clients that do want to be in the market and can't wait forever, you only like a couple of things, right? If you're going to be in the market for less than a year, you're very defensive. Otherwise, you'd stay out.
Well, we're advising that clients really be modestly underweight equities given our cautious outlook. Again, to your point, things aren't excessive in terms of interest rate land, and we are seeing some slight green shoots when we look at month-over-month activity and a few things picking up. But again, our general advice would be to be cautious and relatively to put that more in the real asset category, including both listed real estate as well as listed global infrastructure.